Welcome back to Investing Talk Podcast.
Today we're looking at Nebius Group.
As usual, before we start, subscribe, like, and comment to this video to support the show. It really helps us out.
And you're definitely going to want to stick around for this one because if you've been watching the headlines, you know Nebius isn't just another generic cloud company.
Right.
They are an AI cloud infrastructure play that has managed to hit over $1.2 billion in annualized run rate by the end of 2025.
Which is just, it's staggering.
Exactly. Effectively, they're acting as the engine room for the entire AI explosion we're seeing right now.
So, I mean, the tension here is pretty palpable. You've got this company putting up triple-digit growth numbers that, frankly, look like typos when you first read them.
Yeah, they really do.
And they're backed by absolute titans, NVIDIA, Microsoft. But on the other side of the coin, you have serious sector headwinds.
Huge headwinds.
Fears of an AI bubble, competitors stumbling. So our mission today is really to figure out, is Nebius the exception to the rule? Or are they just next in line for a nasty correction?
That really is the billion-dollar question.
Right. And frankly, when I look at a company growing this fast, my alarm bells always start ringing.
Sure.
It usually implies things are either breaking behind the scenes or the valuation is just completely disconnected from reality. So let's look under the hood. You mentioned the revenue earlier. What are the actual fundamentals telling us?
Okay, so let's start with the headline number for Q4 2025. It came in at $227.7 million.
Okay.
Now, context is everything here. That might not sound like massive money compared to, Google or an Amazon.
Right, it's a fraction of that.
But you have to look at the velocity. That is a 547% year-over-year growth rate.
Wait, 547%? That is just aggressive?
It's explosive.
Yeah.
And crucially, it's not just a year-over-year fluke. Like, they didn't just have a terrible quarter last year that makes this one look good.
A base effect, right?
Exactly. You look at it quarter-over-quarter, they grew 55% sequentially.
Wow.
So that tells me the momentum is actually accelerating. It's not slowing down. They're bringing new capacity online.
Yeah. New servers, chips.
Right. New servers and chips, and they are filling them instantly.
Okay, but let's pause on that run rate concept for a second, because I feel like management teams love to throw around ARR, annualized run rate, because it just makes the future look rosier than the present.
It does.
For you listening, if you aren't deep in finance, ARR is basically taking your current month or quarter and just multiplying it out, as if nothing changes for an entire year.
Right. It's a projection.
Exactly. So are we just looking at spreadsheets here? Like, is this actually sustainable?
It's a fair skepticism to have. ARR is just a snapshot. It assumes the music keeps playing.
Yeah.
But look at the actual guidance they're putting out.
Okay.
They aren't hiding behind the ARR. They're targeting $3 billion to $3.4 billion in actual revenue for 2026.
That's real money.
And the long-term goal.
Yeah.
They want to hit an ARR of $7 billion to $9 billion by the end of 2026.
7 to 9 billion in 1 year. That is a massive leap from where they are today. How do they even justify that? Usually when you scale that fast, you run out of one of two things.
Customers or product.
Exactly. So which is it here?
Well, this is where it gets fascinating. They aren't chasing customers. The customers are already lined up outside the door.
Really?
Yeah. They have what I'd call a massive safety net. It's a revenue backlog of $20 billion.
Wait, 20 billion?
20 billion.
Okay, let's clarify backlog here. Because in this industry, is that just a letter of intent? Like a handshake that can be broken if the market turns?
No, and that's the key distinction to make. We aren't talking about vague letters of intent from, startups that might go bust next month.
Right.
We're talking about multi-billion-dollar committed contracts with OpenAI and Meta.
Okay, so the kings of the AI hill right now.
Exactly. Plus, they have a strategic partnership with Microsoft. And the first tranche of that was actually delivered on schedule.
That's huge.
And let's not forget the $2 billion direct investment from NVIDIA.
Okay, yeah. That NVIDIA investment is a massive vote of confidence. I mean, NVIDIA doesn't usually just throw $2 billion at vaporware.
No, they don't.
They want to ensure their chips actually have a home.
Yeah.
But let's check the math on the profitability here,
Sure.
because usually infrastructure, building physical data centers is a notoriously low-margin game.
Historically, yeah.
You have to buy the chips, pay for land, pay for the electricity, cool the servers. It just eats up cash. So how are their margins actually looking?
So this is the metric that really separates Nebius from a standard data center play or just a commodity hardware provider. Their gross margins are holding at 70%.
70%. Wait,
That's
that's
software level margin.
Yeah, a standard software company has 70 to 80% margins because they're literally just copy pasting code.
Right.
Infrastructure usually sits way lower, maybe 30 or 40% if they are having a great year. How on earth are they pulling 70%?
Well, it suggests they have immense pricing power. The demand for high-end GPU compute is so incredibly high right now that they can just charge a massive premium.
Supply and demand.
Exactly. But it also implies they have a highly efficient software stack running on top of that physical hardware.
Ah, okay.
And that efficiency is trickling down to the bottom line, or at least the EBITDA line.
Right, EBITDA, earnings before interest, taxes, depreciation, and amortization.
Exactly. Basically, operational cash flow before the accountants step in.
Right. So how does that look?
Their core-adjusted EBITDA margin expanded to 24%, and that's up from 19% just the prior quarter.
Okay, so that signals operational leverage. As they get bigger, they're actually becoming more profitable, not less.
Yes. They aren't sacrificing their margins just to buy growth, which is really rare in this space.
So they are actually making money on the core operations despite these massive build-out costs.
They are.
Speaking of the build-out, where is all this computing power actually living? I mean, you can't run $9 billion of ARR out of a warehouse.
No, you definitely need heavy industrial capacity, and they're building out 9 new data centers simultaneously right now.
9.
9. And they have over 3 gigawatts of contracted power.
Let's just put 3 gigawatts in perspective for you listening. That is roughly the power consumption of a major city like Berlin or Madrid.
It's unbelievable scale.
Mhm.
And they aren't just building empty concrete shells either. They're aggressively acquiring tech to deepen their moat.
Like what?
They picked up companies like Tavily, Token Factory, Aether, and Monolith AI.
Right, so they're buying up the software layer to make the actual hardware stickier for the client.
Exactly.
It's not just, hey, rent a server from us. It's rent our entire platform.
Precisely. It creates ecosystem lock-in.
Okay, so bridging from the fundamentals over to the technicals and the price action.
Do it.
Because the fundamentals sound great, almost too great, but the market is a fickle beast. How is the stock actually trading?
It has been an absolute breakout story. Just recently, on February 18, 2026, Compass Point initiated a buy rating with the $150 price target.
Okay, and I imagine the stock jumped on that.
It jumped immediately. But what's actually more telling to me is the divergence we're seeing.
Divergence against what? The broader market.
Against their specific sector. So over the last 6 months, while the broader internet software sector declined by nearly 10%.
Ouch. So the whole neighborhood is kind of going down.
Exactly. The sector is struggling. But Nebius gained 50.8% in that exact same period.
That is a massive spread.
It is.
So the sector cools off, but Nebius heats up. That usually tells me investors are rotating their capital. They're selling the losers and piling everything into the obvious winners.
That's exactly how I read it. It's a flight to quality. And the resilience of the stock is really striking.
How so?
Even when they've had bad news or there are broad market jitters, we see this incredibly strong buy-the-dip behavior from investors.
Right.
Shares gained over 20% in just the prior week alone. The stock keeps making higher highs. I mean, we are looking at a trend that is up over 200% in 2025.
But it's got to be volatile, right? With that kind of hyper growth, it must swing pretty wildly day to day.
Oh, absolutely. The implied volatility is very high. It reacts sharply to any news.
Sure.
But the key takeaway is that despite the shakes, the overall momentum flow remains strictly upward. Buyers are stepping in aggressively every single time it softens.
Which really segues nicely into the sentiment right now, the market psychology.
Yeah.
Because it feels like there's a bit of a mixed narrative playing out here.
Very much so.
On one side, you have the profitability bulls, and on the other, you have the AI bubble bears.
It's a classic battleground stock. On February 23rd, we saw headlines like, Nebius profitable on EBITDA basis as AI cloud demand explodes.
The market obviously loves that pivot to profitability.
It totally de-risks the story for them. It tells investors, look, we aren't just burning cash in a furnace. The business model works.
But then you have the other side of the coin.
Right. Just a few days earlier, on February 20th, we had headlines warning about neocloud contagion, specifically CoreWeave's financing woes dragging down Nebius.
Right, CoreWeave. We definitely need to explain this connection for the listener. CoreWeave is a direct competitor in this GPU cloud space.
They are.
They do almost exactly what Nebius does.
Correct. And so if CoreWeave is suddenly having trouble getting financing, The fear is that the banks are just closing the tap for everyone.
Right. If the banks think the AI infrastructure trade is oversaturated, they just stop lending money across the board.
That is the contagion fear.
It's like if your neighbor can't pay their mortgage, the property values on the whole street might take a hit.
That's a great analogy. But so far, the analysts aren't really buying the contagion story for Nebius specifically.
They aren't.
No. You have Zacks rank number 2, which is a solid buy.
Okay.
You have Compass Point explicitly countering that whole structural headwinds narrative.
What's their argument?
They're saying, look at the specific execution of Nebius, not just the neighborhood they live in. Nebius has the cash flow and the massive partners that CoreWeave might lack.
And what about the institutional vibe? Like, are the big money players showing their hand yet?
It's actually a bit quiet on the official SEC filings. No massive clusters of insider buying recently.
Interesting.
But the rumor mill is extremely active right now.
What are the rumors saying?
There's a lot of excitement and chatter around the potential deployment of NVIDIA's Rubin tech.
Rubin. Okay, for those not tracking the semiconductor roadmap every single day, that's the next-gen architecture, right, after Blackwell.
Correct. Blackwell's the big rollout right now, but Rubin is the future.
Right.
If Nebius is one of the very first to deploy Rubin, that completely cements their status as a premium provider.
Because it validates that tight relationship with NVIDIA.
Exactly. It means they aren't just getting the leftovers, they are getting the prime cuts straight from Jensen.
Okay, but I have to play the skeptic here. It's my job.
Go for it.
We can't just look at all these rosy projections and fancy new chips without looking at the downside. So let's pivot and dig into the bear case here. The risks.
Let's do it.
Because they did actually miss earnings recently, didn't they?
They did. In Q4 2025, they reported an EPS, an earnings per share, of negative 68 cents.
Okay.
The street estimate was a loss of only 54 cents.
So they missed by 14 cents.
Right.
That is not a small miss percentage-wise. Why did that happen? Was it a demand issue? Did a bunch of customers bail on them?
No, and that's a really important detail. The official reason was guidance cuts resulting from shell delays.
Shell delays. That's a construction term?
Yeah, basically construction delays. They just couldn't get the physical buildings finished fast enough to put the servers inside them.
Which makes total sense when you think about it. Trying to build 9 data centers simultaneously is a complete logistical nightmare.
Absolutely.
Concrete doesn't dry any faster just because AI demand is high.
Exactly.
And you've got global supply chain issues for massive cooling units, power distribution gear.
Right. And that really ties into the bigger risk here, which is execution.
Right.
They are trying to deploy 3 gigawatts of power. Scaling from 170 megawatts all the way to gigawatt scale is not just a matter of plugging in more servers.
It's a completely different operational beast.
Entirely. You're dealing with regional grid constraints, complex permitting, the raw physics of cooling that much hardware.
Things can and do go wrong at that scale.
Frequently.
And then there's the money question. We mentioned CoreWeave earlier.
Yeah.
If we really are in a data center bubble, or if financing dries up because banks just get nervous about AI overcapacity, Nebius needs massive capital to finish those 9 buildings.
That is the sector contagion risk right there.
Yeah.
If the market suddenly turns on AI infrastructure, Nebius still requires heavy CapEx, capital expenditures.
Which means spending cash today to make money tomorrow.
Right. And if they can't raise debt cheaply, or if their stock tanks and they can't issue new equity to raise cash, that entire growth engine could just stall out.
Because it is such a capital-intensive business, you literally have to spend billions to make billions.
You do.
So if the music stops, they are potentially left holding a very expensive bag of unfinished buildings and depreciating GPUs.
That is definitely the worst case scenario.
However,
there is. Having Microsoft and Meta on multi-year committed contracts mitigates that risk significantly.
Okay, true.
Those checks are very likely to clear regardless of what the bond market decides to do next week.
That's a very fair point. A contract with Meta is about as good as a treasury bond these days.
Exactly.
So bringing all this together for the final verdict, we have a company with explosive growth, huge backers, great margins, but they are facing real execution hurdles and general sector anxiety.
Right.
Sarah, actually, let's just get straight to the score. Where do you land on Nebius?
I am giving this a bullish score of 8 out of 10.
An 8 out of 10. That is pretty high given the sheer scale of the construction risks we just went over.
It is.
Walk me through the thesis. Why an 8?
It all comes down to visibility. Nebius isn't just a speculative AI play anymore.
Right.
They are a high-growth infrastructure play with a $20 billion backlog that lets us see their revenue clearly all the way through 2027.
That's where.
It is. We aren't guessing if the customers will show up eventually. They've already signed the contracts.
And the margins.
That is the real kicker here. The combination of 70% gross margins and their emerging EBITDA profitability makes this so much safer than the pure speculative plays out there.
The ones that are just burning cash with no end in sight.
Exactly. Nebius is actually proving that the economics of this work.
So you view the construction delays, the EPS miss, the CoreWeave drama, you view all of that as just noise.
I view them as transient.
Yeah.
Yes, construction at this scale is hard. And yes, the sector is going to be volatile.
Sure.
But compared to the multi-year secular demand from the likes of Microsoft and OpenAI, these are speed bumps. They aren't roadblocks.
The demand for compute really is the defining trend of the decade right now.
Unquestionably.
So what is the time frame for you listening? Is this a quick swing trade? A day trade?
Absolutely not. This is a multi-year hold into 2026 and beyond.
Okay.
You want to be holding this to see if they actually hit that $7 billion to $9 billion ARR target,
Yep.
because that is where the massive repricing of the stock happens.
So buckle up, ignore the weekly volatility in the charts, and just watch their execution on those data centers.
Exactly. If they build it, the revenue is already sitting there waiting.
Well, there you have it, a high-stakes race to build the engine room of the entire AI economy. It is definitely one we will be watching very closely over the next year.
Definitely.
Don't forget to subscribe, like, and comment to support the show. We will see you next time.